All right, Brendan, before we get too deep into the topic, I think it's valuable for whoever's watching this to understand what your company does and what you do. Typically, I won't go that route, but I think it will frame the discussion here and how you even got to this point. What's the backdrop on how you get to today?
Yeah, I'm co-CEO and co-founder of Dynamico, and we are best known right now as a leading HubSpot CRM partner, and one of the three verticals that we're focused on is franchises, which of course is how you and I were connected. And the franchise industry is one of those industries where the more you learn about it, the more exciting it is. But anyway, so we work with a number of large franchises to help them better use their systems to align with the goals that their leadership have from a process and growth perspective. And then, of course, to facilitate a lot of the other things that they're doing from a sales and marketing perspective.
Okay, so one thing that I hear that is arguably wrong in what you just said, we work with a lot of larger brands that align the process back to what the leadership team wants. Mm-hmm. My issue with that is so many franchisors get out of the gates. You're not saying we work with emerging brands. Mm-hmm. And so is a gap because they don't value what you do? Is a gap because they don't understand the importance of having the technology side of the business incorporated? Like why is it the bigger brands that say, of course we need to understand how this works? Why doesn't the emerging brand buy into it?
Yeah, that's a really good question. Because I think, and I think it's kind of linked to what makes the franchise industry so exciting, right? It's so exciting from a community perspective, but it's also exciting from a growth creation perspective. And I think a lot of franchise owners go into it not really knowing where the value chain is, and I think they get pretty deep into it before they realize where they're leaving a lot of money on the table, and more importantly, where they're leaving their brand and their franchisees hanging a little. And I think, but when they and then of course there are some leadership teams of these big franchise groups who get this faster than others. But when they get it, they realize, okay, when you get back to the basics, any business, whether franchise or not, is about leadership and systems. And the way that any business is valued, whether it's valued for internal purposes or external purposes, it's valued based on those two things: leadership and management, and systems. That's what builds and creates continuing and growing value over time.
So what I'm hearing, though, is maybe a brand, call it somewhere between 1 and 100 units. And I would say, like, there's a transformation typically around 50 locations that they say, oh boy, let's make sure there's enough insight that this business is going to take off, which therefore some of the preparation for eventual exit might take a little bit different of a turn of the investment. So having the right system, processes, technologies, data pools, processing the candidates happen around that point. Mm-hmm. But I think, and this is the hard part. If we take the journey of a franchise brand, you franchise your business. Call it, you spend $100,000 to franchise your business. Mm-hmm. The two elements you get out of that is an FDD and an ops manual, like in essence. Then so many times I get a hold of a brand somewhere between 1 and 10 units, and they're like, well, what do we do now? I'm like, well, why was that not a part of franchising your business? Mm-hmm. And then we start talking about CRMs, and I for a very long time have been a big supporter of HubSpot. We've been investing a little bit heavier into go high level because it is a cost effective for the emerging brands.
Mm-hmm.
But they don't put the infrastructure in place. So now you franchise your business, you have an FDD and an ops manual, you don't know how to award franchises. And they say, okay, now we're going to go spend on franchise marketing, which could be a franchise portal or the franchise brokers.
Mm-hmm.
At this point, what we haven't done is we don't understand the value of a franchisee back to our system. And so we value that franchisee as basically the franchise fee, not the royalty or continuation or the valuation of that business. So I'm gonna park that over here.
Mm-hmm.
I was with a brand the last few days in Dallas, emerging brand, beautiful business. I was working on their assessment this morning. And I said they very well could be the top of the emerging brands that I've seen for
Mm-hmm.
operational excellence and business potential, and then sales volume. They'll hit about $2 million AUV. For an emerging brand is quite significant.
Mm-hmm.
I asked a few questions that they didn't have the answer to, such as your average ticket, is that per customer or is that per ticket? I think it's per ticket. What's the lifetime value of that customer? We don't know. If I then go back to the FDD and say, okay, so we come out and say this is what our grand opening marketing spend is. If we don't have those answers, then when we earmark $15,000, $10,000, $20,000 for a grand opening, we're just pulling that number out of the sky. And so now, because we haven't taken the data and cross-applied it back to what is the race to break even for this franchisee, we don't know. And so when you play in I don't knows, now the odds of that franchisee succeeding goes down. The last thing I'll say, and then I just want your comments on all these words, all this jumble that I just threw out there.
Yeah.
I keep on going back to the deal value, that if we're talking about an investment into technology that will show you predictability in your funnel and show you how the candidate behaves and where they fall off. And if I said whether that's $10,000 or $25,000 or $50,000 or 100, if I go to one franchisee and take 3 years royalty at $2 million AUV, so that's going to be $6 million over the first 3 years, that franchisee is going to pay $150,000 in royalty. Mm-hmm. And so when I look at the value, that's not even the lifetime value of a franchisee, that's just a 3-year run rate. I'm like, wouldn't you spend that money on technology? Wouldn't you invest it? But then comes the next gap, which is I just don't have the capital. I need the franchisee to get the capital to be able to make these investments. And that's where, like, it's all backward, because what you're saying, established brand, leadership aligned with process, in my opinion, should start at unit 1.
Absolutely. Yeah. I think and this is a challenge that you see again across all kinds of industries, and it's an interesting observation of yours, that we are working with larger franchises that are typically at 100+ units, and I would love to work with emerging brands. The thing is, they haven't yet felt the pain of not having systems in place. Again, because they're not thinking strategically enough yet, and this happens for single businesses in every industry, where the leaders of those businesses will look back and say, "Oh my gosh, if I knew we had done that 3 years earlier, we would have been so much further ahead now." But that's just not reality. That's just not how the humans that are running these businesses, that's just not how we think. The pain of investing in something or changing something has to be greater than what we currently have, and unfortunately that's just the way it is. So I would love to work with emerging brands who let's just, like, there's one example that I'm thinking of now, where it's a local franchise. They were probably at like 6 or 7 or 8, fully owned businesses that they then that's when they realized, okay, well, actually, we want to franchise this thing. If we were able to get involved with them from the very beginning, we know we could have done so much more to help them, but again, the pain just wasn't there. They needed to get through certain things, and we know that by the time they get to 50 or hopefully it won't be 100, but they're going to realize the importance of aligning their systems with. We talk about data, but even if you skip the data component and go straight to the processes and the people that really make their brand grow. And to your point, I think the data point that you mentioned, which I really like, that I think is one that franchise in the franchise industry they just don't talk about, and they really should be thinking about, is LTV. So what is the lifetime value of the franchise, or a single franchisee, or the customer of a franchisee? That is just not a metric that is used in the franchise industry, which I think if it were, these investments would be happening a lot earlier.
And so a few comments. One is I did a podcast with a really strong franchisor called Kids Strong. They're in the wellness business for children.
Mm-hmm.
Their co-founder came out of tech. He built up an app that made a lot of money and sold it for a lot of money. He took a SaaS approach to the franchise. And so that was happening in staffing. It was happening in technology. It was happening in data. And now you take a brand that was non-existent 5 years ago and now is a major player in the category. And as an extension of that, they start bringing in Orange Theory Fitness franchisees who are used to one way of looking at data. And so typically an emerging brand, to get the Orange Theory Fitness franchisee in, it would be a battle. Well, why don't you have this? Why is this not in place? But they said, we're going to over-index and treat it like a SaaS company, which in turn accelerated their growth, which in turn brought franchisees who were well capitalized, which in turn those franchisees spent money on marketing, which in turn they drove more customers, which in turn they opened up more units. And so it's interesting. And look, you and I talked about this on your podcast, that I can't just point the finger at this. Like, I was internally with our system, even though I preach it to all of our clients, I was like, we'll worry about the operation side later. We'll worry about the technology piece on how we operationalize our business, on how we take a client wants us to write a piece of content, to how do we get it up on 1851, to what is the readership of that piece, to now how do we market it. I was like, I mean, like, we'll just use Google Sheets. And so I get it. Like, I understand the mindset, and that shifts it, but Kids Strong out of the gates, strong focus. Us, we've done great as a business, but our transformation as a business is probably happening more so now since our CEO put the processes in place, and now what happens is fewer employees turnover, client retention is going to be stronger. We have data on satisfaction with the client, like all the things that we need. If I could flash backward and say, I probably over-index in investing in people first versus process. If I would have gone process then people, it could have been a different story for our company. Not bad, just different, and an acceleration. So with all that being said, let's say there's a brand. You said you put a marker at 100 units. Let's say there's a brand at 25 on here. If they're listening, they're like, okay, I'm bought in. Like, ballpark budget wise, what should they be thinking of? And it's not necessarily specific to you. Like, you just want to go through a process, data, technology transformation. Like, what kind of investment am I looking at?
Well, what's interesting about that question is that it doesn't really change that much whether you're 25 units or 100 or 200 units, because ultimately what we're talking about is from a software perspective, there's not that much difference in price. Obviously you're paying more license fees and all that kind of stuff for the software that you're using, But for the implementation, I think, and this is one of the benefits that franchises have that other industries don't have, is you can amortize a big chunk of the investment in the processes and the training of how everybody uses the technology ultimately across 25 or 100 or 150 different business units essentially. But I would say, you could, again, depending on the complexities of, because there are franchises and then there are franchises. As a side note, we tend to work with a lot more B2B franchises versus consumer franchises. Even though by default the franchise model is B2B2C, we tend to work with franchises that are either business to business franchises, or they have much bigger tickets, right? So we're not talking about $5 tickets. We're talking about hundreds of $1,000 tickets, or at least multiple tens of thousands tickets, or you're selling to a team, like some of the sports type franchises. You're selling to a team, not to a consumer. So that's more of a side note. And I think, but it probably is a factor in. So for example, if a franchise is trying to decide between a CRM or a marketing automation platform or whatever, one of the reasons that they might go for a less expensive option versus HubSpot, for example, and again, from our perspective, HubSpot is not expensive. It all depends in what your total opportunity cost is as you're evaluating, which is part of what I was starting to talk about earlier, is that the lack of, and I think where you're going is the lack of strategic thinking is, if we invest in this now, how much faster do we see value from what we're doing? But anyway, just back to what I was saying. So a lot of franchise brands are going to select less expensive software if the franchisees are selling lower ticket items, right? So if you're selling, cupcakes or subscriptions, monthly subscriptions that are, under $100 a month, you're naturally going to be thinking smaller in all aspects. So how you choose your technology, you're going to be thinking about a more transactional, less expensive technology whereas some of the bigger franchises that we work with, they're thinking about how is this technology going to help us through automation take more time and responsibility of the people that are handling tickets, and that's where the value really comes in. So if you're paying a couple of $100 a month for your software versus a couple of $1,000 a month for your software, when you start measuring that in the time that people would otherwise have to do that manually, I mean, the amortization happens literally within hours, not even days or weeks or months. But again, this is just part of the process that I was referring to earlier, where the leadership groups that are making these decisions, the pain has to show up week after week or quarter after quarter as they're doing their planning, for them to go, you know what, like this is crazy. We need to be a lot smarter about how we're doing this, because we're not helping ourselves, we're not helping our franchisees, and we're definitely not helping the value that our total brand can provide to potential customers.
Okay, I want to stay on this a little bit more, and I'm gonna press you on this, but I'll create a blanket statement on it, because so we'll remove, for argument's sake, we'll remove the B2C side, so no longer the product there. Because if we say B2B, a franchisor, per the example that I gave, 3-year royalty is going to be $150,000. That's a big ticket. That's big ticket sales. That's B2B sales, where you're convincing someone to invest their life savings into a business, right?
Yeah. So to answer your question, that one will pay for your entire investment typically. Okay. In your technology.
Right.
which
So
includes the software and the implementation and the training. And if it's, again, more complex, or there are various factors that go into it, even if it ends up being 300,000, typically, even at 25 units, you're all covered by the time you've sold the second franchise.
and you can build it back into the way that you build out your charging systems. Like this could be a part of let's just say you increase your franchise fee to offset monthly cost by $5,000. So you go from 30 to 35. Now you earmark 5,000 of that for the technology side of acquiring more franchisees. Like whether it's done purposely or in the back of your head, like you can start financing this.
Yeah.
And you said like CRMs, a few $100 or a few $1,000 for the monthly run. So, and you and I talked a little bit about this, but I had the pleasure of working with a bank, the trust division. The exercise that we went through, I built out the architecture for how could we gain data and leverage data to give insights back to sales teams that someone was ready to move assets under management.
Mm-hmm.
If I go to the number one challenge that a franchisor faces right now, like the pain point, if you pulled every franchisor that you and I could pull into a room together, they all show up on this call,
Mm-hmm.
and said, do you have pain when there's no leads? They're going to say, oh my God. Like they have this like panic attack if the leads aren't coming in on a daily basis.
Mm-hmm.
What they under index is how long did that lead, that seed take to go from it's been planted, I'm interested in owning a franchise, to it now is like it's sprouting. So now I'm raising my hand and saying I want to fill out the form.
Yeah.
And so what we had to do at the bank, we found 6 quarters was the time. Even when we had the right target, we could pull a customer out of the bank that had over $1 million in their bank account,
Mm-hmm.
and say, there's an insight. And next box, they don't use the bank for trust management, for money management. We had those 2 insights, 6 quarters. If I go back to franchisors, say it's going to take you 6 quarters to get a deal, whatever you spend today, you get the engine going,
Mm-hmm.
it's going to show its face. They're like, absolutely not. I need leads today.
Mm-hmm.
And so without having that data structure to know how the candidate is behaving, the pain points only compound, but they never say, well, we have to diagnose basically what was happening. In the number that we've come up with, the 6.4 months ago, is when there's an impression created.
Mm-hmm.
And so if we look back from right now, August 13th, go back 6 months, and we pool everybody that is starting to have a little bit of turbulence in place, that there's a new president that's been in for 1 month. They're like, oh, I don't know what's going to happen. And so there's tons of turbulence. So we look backwards 6 months, and now dust is settling. The world didn't end. And now I might start looking at a franchise. And so I say all this because we just say on the B2B side, like, how does a franchisor go acquire the franchisee?
Mm-hmm.
I think, 1, this will help you sleep better at night because you'll have predictability in your funnel. 2, the automations will offset time investment, so your franchise sales team can actually go out there and build relationships versus feel like they're in this constant hamster wheel of selling. And then 3, they'll close more deals, which in turn at that $150,000 for just 3 years of royalty. And I'm not even saying that franchisee is going to even scale. I'm just saying they're going to get one.
Mm-hmm.
Like, all that has to be worth something, right?
Yeah. Well, and I think, like you and I talked about before, so the way we talk about it is data driven, right? Which is why for us, it's people, process, data, and technology. And I guess to give a lot of, big franchise and successful franchise brands the credit, they don't invest in the technology until they know that they have the people, processes, and data piece figured out. But like you and I talked about before, in fact, ROI, is an acronym that pretty much anyone in business is familiar with. But if you were to ask, franchise leaders, what is more important, the R or the I? it's you have to actually stop and think about it. And the reality is that there is no R without the I, right? So that was just an interesting sort of thing that came up recently, in this sort of data component. And when you're trying to figure out what your data is in a business, so we talked earlier about LTV, so lifetime value. I think you and I agree it would be awesome and life-changing for so many franchise brands if they made LTV a more important metric. And then to the stuff that you deal with every day, the second most important metric, potentially, arguably, is CAC. So the cost of acquisition, which is what you're talking about now. And what you and I are talking about now also is the Fran Dev component. What is the cost to acquire a franchisee, not the cost for the franchisee to acquire a customer for their particular franchise. But I think the reason you want to be data driven is because it's all linked back to what you were talking about around funding and financing and understanding what you need to invest in a franchise to be successful. And the analogy I always use is, and I love airplanes, and I'll remember the first time I got on an airplane when I was 10 years old, and the airplanes weren't as advanced back in those days as they are now. But I think everybody knows when the first time you walk up a jet into a jet, and you typically look left, and there's the cockpit, and you go, oh my gosh, these pilots, don't get me wrong, they're very smart people, and they're highly trained and chosen specifically for their unique skills. But I think the first thought that we all had when we saw that cockpit for the first time is, oh my gosh, how do these pilots know which buttons and levers to push and pull at any time? It must be impossible to keep track. But the reality is that they're only keeping track of three things at any one time. And I think that's the way that any business, but in the context of franchises, I think every franchise needs to have their three primary metrics. And I'm just throwing out there that LTV and CAC might be amongst those, but those are really more on the customer or the franchise acquisition front. They might have different metrics for different things, but it all comes back to how much do you need to invest today to see success earlier. And I think a lot of the way that a lot of franchises are started, especially emerging brands, they're not started by a PE firm because otherwise they wouldn't be emerging, right? So they're started because these are very, very smart entrepreneurial people who've realized that the best way to scale and add value and provide more of the magic that they provide to more people is through franchising. But they're used to bootstrapping. They've bootstrapped, in many cases, they've bootstrapped everything they've done in their entire lives. And they're very, very careful about how they invest their cash, potentially to a fault, but they've been very successful. So why change now? I think what you and I are potentially just throwing out there is, if you were, and right now, as you mentioned, it's August 13th, 2025. We're all caught in the same dilemma of the crisis and opportunity that is being provided by AI, and how we respond to that. How and when do you invest in technology, which AI is just an extension of, and how does that align with your growth goals for your franchise brand? And I don't think we're sharing anything that any franchise leaders haven't thought about. It's just maybe it's something that they're dealing with right now, where it's like, what is that particular pain that they're dealing with right now that might push them to go, that $150,000 or $200,000 that we've been sort of sitting on not knowing how to invest, that maybe it's time to do that today.
Yeah, I wrote down a whole bunch of things when you're talking. What I love about these conversations that I've had with you is it ignites my brain to think through things. So
Likewise.
yeah, I appreciate that. One thing that comes top of mind, and I've used this story many times. We were in a room with Slim Chickens early on with the founders, and I said, "What's winning?" And they said, 25 franchisees who each own 5 units. And I was like, in my head, I'm like, okay, they're gonna say in the next like 6 months. I go, by when? And they said, whatever it takes. And that's an impactful moment on my career because founders, now very entrepreneurial, but they found a way to make some money off of their initial units, had some early success, and then said, this is what winning is. And I think about that. For 99% of franchisors, they look very, very linear, that a franchise sale is a franchise sale. But a franchise sale, we'll take the example of the one that I was given earlier at $150,000 in 3 years. Forget about 10. So we'll extend it out to we'll make it 10 years. So each franchisee, each unit is worth $1.5 million in royalty back to the business. If that franchisee is indeed hitting that $2 million mark, the odds of them continuing to scale are higher. And so if we go backwards to customer acquisition costs and lifetime value of a customer, we engineer the roadmap of the business properly to drive that $2 million AUV. Some of the early expectation setting that we decided on how we onboard a franchisee is going to make them successful. So now we make unit 1 successful. Most franchisees that have unit 1 be successful go to unit 2, unit 3, unit 4, unit 5, etc. So they, even if they stall out at 3, that's $4.5 million that one franchisee in that sample size is worth. If we go even downward and say, let's just split it in half, let's go down to a franchise system that does $1 million, that they get to opening up 3, that's still worth north of $1 million for the business. And so now we say, how much time, energy, and money are we willing to invest in that candidate? It's not a lot. And we might have a lower quality person do call 1 with that candidate when they come in, which doesn't wow them. We're not getting on an airplane to close $1 million deal. But for me and you, if someone knocked on our door today and said, hey, there's $1 million opportunity, we could get on a plane and go see them and have dinner with them, we'd be like, absolutely. And so it's interesting because I agree. Super entrepreneurs who create these businesses, super bootstrapping, that's business 1. When you get to business 2, which is franchising, the bootstrapping's got to stop if you want to be great, or else you're playing a major crapshoot. Because if you bootstrap on the first 10 franchisees and they don't perform and you haven't constructed the business right, that's where you fail. And that's so the statement is, the gap 1 is the franchise consultants who are not coaching properly to these entrepreneurs when they're like, I have years of experience. They have more responsibility to set these businesses up. Maybe they're not incentivized because they don't get paid enough, but that's issue 1. And then issue 2 is kind of what we're talking about, of setting the tone so that you can flip it and do investment on return, or get rid of on and change it to investment to return is the mindset once you go franchising. Any comments on that?
Yeah, well, it as you were talking, it was I was in a conversation last night with a friend who just happens to be also my orthopedic surgeon, and we were actually playing 9 holes of golf yesterday evening, and I'm not sure exactly what I did, but he was like, I had a knee replacement 22 years ago, which is long before I met him, and he's like, oh, how's that knee replacement working out for you? And I was like, oh, it's great. It's been 22 years and it's still amazing. It was life-changing for me, right? And he's like, oh, I was just, in Dallas at a conference where they've, to be trained on a new, knee replacement technology. And so he was chatting. So essentially what this company who's created this this new product, which is going to be life-changing for millions of people probably going forward, but they haven't made 1 cent yet. They're flying these highly paid surgeons to stay in a very nice hotel in Dallas. I don't know how many, a couple of hundred doctors that are there for an entire week. I don't know what that cost, but it comes back to the R&D, that question I think that we're talking about is how much, and of course this is where, PE companies in the franchise space, they get this, right? But the question is, what can bootstrapped entrepreneurs, as they need to change that ship or that mindset when they become franchisors, franchise brand owners, how do they need to change how they think about R&D, investment? What is the investment they need to make today to have a much better chance of a very, very good future for many, many people, right? And they need to feel like it's their responsibility to make their product or service available to as many people on the planet as possible, because otherwise, they're not really living up to the full potential of their product, service, and business. And I think I just thought that was a really good example of companies that really, it's probably because they don't have a choice. They have to do R&D because they have all kinds of FDA approvals and whatever that has to happen. But if you think about that, whatever that money is that they invest in R&D, once they're off to the races, the value that they create over time, again, lifetime value, is immense. And right now their CAC is off the charts. It's about as high as you can measure CAC in relation to LTV. But over time, their LTV is going to go this way and their CAC is going to go this way, which is it's an extreme example. But it's like, why wouldn't you use that as a franchise brand? Even if your LTV line is a little flatter and your CAC line is a little flatter, once those lines cross and LTV just takes off. Anyway, I was just rambling a bit there, but hopefully that's helpful.
No, I agree with it. So when you were saying that, if I was laying out the best case scenario, and the statement I'll make is that I've had and continue to have plenty of opportunities to be an investor with a franchisor at various levels, 0 to call it 50% equity into a franchisor. Mm-hmm. Most of the time, the reason I'm getting brought in is because I have to come in and save or fix an issue. And so if a franchisor wanted to do this right, then, and even at, more of an emerging brand that pushed pause a little bit on franchise sales and said, we're going to spend the next 12 months doing a few things. One, we're going to stockpile cash because we should have unit 1 or whatever our corporate operations should kick off some cash. Mm-hmm. We're going to put that to the side so that we're well capitalized for even, let's just say, we're going to freeze franchising. If something comes in, we're not going to shut it off, but we're not going to announce that we're freezing franchising, but we're going to not spend on the marketing side. We're going to focus on the foundational side for the next 6 months, year. We're going to stockpile the cash so that we have enough cash to now deploy at a pace that is going to get us momentum in those markets. We're going to go back and look at the people, process, tech, and data to make sure that is sound. And we're really going to study lifetime value of both our franchisee and our customer so that all the decisions that we make there on out are designed in a race for profitability and scale. In the knee replacement example, the other thing that will happen, the cost of user acquisition is going to be high, but because you said life-changing, the referral will also snag down where the customers that have gone through this change are going to be the validators of the product. And so that's going to pull down the cost per user acquisition as well. And so will the surgeons and the orthopedics, everybody around it.
Yeah.
And so if you were to say, I've used this example many times, but I say franchisors that come to me and say, I want 20 units next year. I'm like, great. We can put together a plan to get there. What if we focus on driving 20, 30, 50, $100,000 in additional revenue back to the franchisees, grow fatter, then grow taller? The pain in that is it hurts financially for a little bit, because you think the money is going to flow in through franchising, but it really doesn't until that third year is what I'm saying. So everything you're saying like makes sense to me. If I was going to start a business fresh tomorrow, I would have a little bit of cash to pay my bills. I would really focus on those four things that we talk: people, process, tech, and data, to make sure that we're sound there. And then I would go launch in a better capital position, because I didn't have like this weird steady bleed,
Yeah, Nick, I have a question for you that I'm curious about, which, because that we don't get to. I know a little bit about it because of just friends who've invested in franchises, but from a business perspective, what we're doing, what we're focused on is setting up the systems for the franchise brands to grow, right? And as we're talking about CAC and LTV, and you've mentioned a couple of times now where the goal of many franchises, if not most, is they want franchisees who take 3, 5, 6, 20 locations, right? And do they ever think about, and that's very much, whether they think about this strategically or not, that is very much an LTV and CAC thought process, right? It's like, well, why would I sell 5 franchises to 5 different people if I can sell 5 franchises to 1, right? My cost of acquisition is 20%, and just everything is just easier and cheaper if you do it that way. But in your experience, do franchises think about this, like, sort of from a fran dev perspective, when the fran dev sales folks are out there thinking about, how do I get one franchisee to take 3, 4, 5 or whatever number of businesses? Do they ever think about the fact that those franchisees have friends who might also be interested in a franchise? Does that form part of that calculation? Because I see it happening all the time. A friend of mine had a bunch of what is the sub brand?
Jersey Mike's.
Yeah, Jersey Mike's. That's right. You and I talked about this before. So I think they had 3 Jersey Mike's, and it was unbelievable. I mean, it was a great business. And of course, as you probably know, Jersey Mike's, won the award last year for the best franchise culture or whatever it is, which is really interesting. But then that same person, they started considering another food franchise and a gym franchise, and everybody who knows that person is like, oh, franchise! I never thought about franchises. Now, so again, they can influence other potential franchise investors. Do you think that ever makes it into the calculation from a fran dev sales perspective?
So a few comments. I feel like that's my answer every time. Every time you say a statement, I have a few comments. One is, like, tactically, when we're looking at what levers can we pull with a franchisor, I say, what other brands do your franchisees own? The reason being, if I can say Jersey Mike's franchisee buys into Nick's Hot Dogs, other Jersey Mike's franchisees are going to see that piece of content. Most likely that Jersey Mike's franchisee is going to share it on their LinkedIn, which in turn is going to make all these people that are in their circle say, well, why are you investing in this? which then creates that aha moment.
Mm-hmm.
The miss is, and I'll say Jersey Mike's is a great case study, and I don't think anybody's really looked at it, but they had no earnings claim forever. What that meant was the only way you could get the earnings claim was to talk to existing franchisees and say, how much are you making? And of course they were disclosing it. And they're like, yes, it's hitting my expectations, which caused people to get in. Secondly, Jersey Mike's was really building the future multi-unit owner. If you look back at their growth projections, it wasn't like they're getting a Popeyes franchisee to buy in. It was they were getting people with a little bit of money who were scaling. Issue with a multi-unit agreement, for what it's worth, is we'll take Minneapolis. You sell a 5-unit deal in Minneapolis, the franchisee is going to take up good territory. The thing that drives the most opportunity in a marketplace is an opening, because now customers are coming in, and once the customer goes, "Oh, I love this product. Oh, I can own this," it opens up an opportunity. When you sell all these territories, now that customer calls in and says, "Oh, I want to buy this," and they're like, "Sorry, we're sold out. Do you want to go all the way over here?" And they're like, "No, that's too far away from my house." And so these franchisors sell these big unit agreements to sell out territory. But what that does is it cannibalizes the market so that the friends and family actually can't get in because it's too locked down.
Right.
Does a franchisor consider this? If I took every franchisor and put them in a room and said, on the count of 3, tell me who your ideal target is, they say the multi-unit franchisee. But if it go all the way back to the beginning, if the FDD, the construct of the business, the investment doesn't set the expectations, I have brands that have numbers in there. Let's say it's $1 million investment, it comes in at 2. I'm not growing anymore. I'm pissed off.
Right.
If my grand opening doesn't drive enough customers so that I'm not hitting those numbers in item 19 that say you can make $2 million, I make $1 million, I'm pissed off. I'm no longer growing. And so now I could talk about this forever. And if you look at the construct, if the franchisee gets pissed off, they signed a 5-unit deal, they've now cannibalized the market, no new blood's coming in, they're pissed off, they're going to stall out on their development agreement, and it's going to stall out the franchisor.
Right.
Jersey Mike's did it right because investment was sound, the investment into marketing and customer acquisition was sound, lifetime value was focused, and it grew. And so I say all this, but so does a brand think about this? Yeah, I look for those gaps because I know that above anything that we do, marketing, PR, marketing, social, shows, portals, all that crap, well more valuable is the franchisee validation and the franchisee testimonial in 1 degree separated. And so franchisees sell franchises. Your question was, do franchisors think about this? They don't. And that's where like in the service sector, the B2B sector, a lot of brands use the franchise broker. You and I touched on this on our last call a little bit. And I go, well, how much are you willing to pay a franchise broker? And they go, $40,000. I said, great, let's park that. How much are you willing to pay one of your current franchisees to make a referral? $2,500. We have an incentive program. We'll pay them $2,500, and it's really good. And I go, so a stranger who has no relationship, hasn't put 1 penny into your business, you're going to give them 40. And someone that trusts you, that loves you, that is invested in you, that has parked their money into you, that has bought into your business, you're going to pay them 25? And they're like, I haven't thought about that. And so it's like there's so many misses in franchising. It's such a beautiful industry. It can do great things, but these misses unfortunately create more losses than wins with franchisors. And if we took every franchisor that's been created, say, over the last 20 years and looked at how many of them won and how many lost, I would say the number is probably 90% lost. And it's because of all the things we've talked about on this call. The foundation just isn't set up. And what's crazy though, I don't think it's too late. I've had plenty of stalled out brands that the words that you said had the pain moment and said, okay, it's time to turn around, or they brought in a leader who's gone through the pain moment and was like, here's what we're doing. And it turns around, because if you go back to the beginning of how these businesses were built, they had to have enough customers. They had to have enough money for anybody to even become a franchisee in the first place. And sometimes they forgot where they came from.
Yeah. Yeah, which is and of course, and this is always the risk when there's so much money involved, that you can be blinded by it, by the fact that there's so much money. And I think, again, across any industry, the businesses that really succeed and play the long game, which I believe is, again, and that's part of the problem, is like, some franchise brands are playing the long game. Others are just trying to figure out how can we make as much money as possible in as little time as possible, because they want to retire or whatever that end point is. And as a side note there, my philosophy and my mindset is arriving. So in that case, like if you think you want to make whatever, 10, 20, 30, $50 million, and then you will have arrived, and you might be, 40, 50 or 60 years old, or whatever it is. My mindset check there is always arriving is the enemy of thriving, right? Just so again, if you're playing the long game and you really believe that you want to be thriving until the day that you die as a business owner or business leader, you have to solve for your customer. And I think, in the franchise space, even though there are incredible brands where the sense of community is off the charts amazing, there are still too many other brands where that is not the case. And it's because they're not solving for, and in this case, it's about partner experience. Like they're not thinking of their franchisees as their customer or partner. I'm not sure how they're thinking about it, the ones that are missing the opportunity. Because everything that we're talking about here, if you think about it, is if you focus all your energy for the entire franchise brand on the franchisees, which includes transparent data, like when they ask a question, give them an accurate answer so that they don't get pissed off with you, a year down the line when they're making $1 million instead of $2 million. But if you take care of them, they will absolutely take care of you. And so I'm thankful for that answer, of that, that they're not thinking about the fact that a franchisee is marketing that franchise every single conversation that they have to the friends and family that they have. But that can flip very quickly when those friends check in, 6 months later at the Sunday barbecue and say, "Oh, Nick, how's that those 5 franchises going?" And he's like, "Oh, well, we're only going to do one now because it hasn't quite worked out the way that." So there suddenly the reputation of that franchise is, ruined, really, unless they do something to turn it around. But now you've essentially giving that example of like Minneapolis, where someone has 5, locations, but they're starting with one and they have a 3 to 5 year runway to get the others done. That, 5 years later, there's going to be one store, and it'll be a failure as far as what was possible, because they were just short-sighted. So the question, I guess, is how do franchise brands take a longer view, and why aren't they taking a longer view?
I mean, statement one would be inside sales versus outside sales. Outside sales is new blood acquisition. Inside sales is what are we doing to sell to our current franchisees. If I took every franchise sales team,
or their friends and family,
or totally, which is an extension. But if I took every franchise salesperson that I've ever worked with and said, okay, break down the percentage of time you spend on internal versus external, I bet your external is close to 100% because of the pressures of the CEO to go sell more franchises. And that's the miss. You already have someone that's invested their money in. What if the sales team was incentivized by the production and success metrics of your current franchisees, because what happens if I go sell a franchisee in, typically sales team is off. It's been handed off to ops and marketing to go now run their businesses. Sales barely touches them. If sales is still touching them and sales says, hey, I'm going to come have dinner with you. I want to come see you. Or magically, business consulting reports into sales so that the consultants that job is to drive profitability for the franchisees actually reports into the chief development officer. That could be a transformation. But the problem is like everything that we're talking about are transformations that do take time, that do feel uncomfortable, that I think like I've had clients where I will talk to them for an hour on how leads work, 6.4 months, the value of a deal, every deal is not created equal, et cetera, et cetera. They're like, yeah, that makes sense. At the end of it, they're like, well, where are my leads? I was like, did we not just talk an hour about how this works? And that's the real hard truth of franchising and probably business in general. There's so much pressure to sell new blood that oftentimes we don't take a step back and say, what if? And so like, I'm going to wrap this up by saying technology wise, we've talked a lot about getting people into the funnel and having the process to now go understand customer acquisition and lifetime value. But I feel you can also use it for the inside sales. Like you could use technology for inside sales. You plug a new customer into a HubSpot. You put when their birthday is, how many children they have, what's their favorite place to eat, are they a vegan, like all these things. And now you put a benchmark in your pipeline that says, did I talk to this customer in the last 2 months? And so now you can move them into a pipeline that if you use technology rightly, it could even trigger like happy birthday. You can set this all up so that technology or AI does some of the work for you. And when you transform everything we just talked about into, we've talked about candidate journey. Now we talk about franchisee journey. I bet you can have some great success in-house too. So,
yeah. I guess my final comment would be, so if you think back over the last hour, what we talked about, a lot of it was around what are the decisions that are being made, what is the data that's being used to make those decisions, why aren't franchise brands making longer term decisions, more, and they're making very much, short term sort of reactive type decisions. I think it comes back down to you cannot manage what you cannot measure, right? And I think what we do is beyond all the awesome things that you just mentioned about the things that you can record in a CRM to build a deeper relationship with every single franchisee. It's the basis for which you measure every single metric that is important to your business. It's your single source of truth for all the data that you need to make a decision in real time. And I think this is the value that a lot of our franchise clients are getting by having, like in this case, HubSpot fully stood up and accessible to leadership and anyone else who cares to know. They can go into their HubSpot CRM. They know exactly what numbers they're looking for. The numbers are available in real time. They don't have to go and print out a report and then have Nancy spend 2 weeks on the spreadsheet putting it all together. It's like we can make a decision right now. So again, I think that's ultimately they can measure what they're doing, which means that they can manage what they're doing, which means they can focus their energy on the relationships with the franchisees that are going to help them grow faster than others.
That's right. Right. Wonderful talking again. I feel like we could talk for another 2 hours and still have things. And I'm hopeful. I mean, obviously we've had an audience watching. I've seen that number tick up and down. Nice. I hope everybody that watched this got value out of this. I mean, at the end of the day, all we're trying to do is get your brain thinking about how you can start making some of these changes. And if any of you didn't see it, you can connect with Brendan on LinkedIn. I gave that in our email too. But Brendan, thank you so much for doing this. This was awesome.
Nick, yeah, it was really, really good to see you again. And I look forward to the next conversation.
Me too. Take care.
Take care.